Hello and welcome everyone. Today we will speak about the life insurance industry, and what a time to speak about that industry. We are in a year where there is a strong growth which the industry has in front of itself, but at the same time there are certain regulatory changes in the form of surrender value. There is some bit of margin pressure which the companies in the sector are experiencing because of the strong sales of market-linked products, and in that, how do companies want to navigate the growth for themselves in this financial year? We're joined by one of the industry leaders, HDFC Life Insurance, Vibha Padalkar, ma'am. Ma'am, thank you so much for having this interaction and sparing the time for this interview. Let's start by something where we left off in the previous interview itself. You had guided for a 15% growth when it comes to the APE as well as the retail APE. Now, I want to, of course, draw your attention to three things that have happened since that interaction. First quarter, your total APE has grown at 23%, retail APE has grown at 30%, much ahead of what you had said. Second quarter is expected to be very strong because surrender value regulations come in from October. Fourth quarter is seasonally strong. All you have to manage is the third quarter. In that sense, 3 out of 4 quarters firing very strong ahead of your estimates. Could we have an upward revision to that 15% number on both APE and retail APE?
So yes, as a sector, I feel very proud that despite very significant changes that happened in the last budget, how as a sector we have come back with a bang has been phenomenal, and that's what makes me really proud. Yes, we had a flattish or slightly degrowth for the sector last year, and everyone almost wrote us off, and so yes, it's been a good first 4 months. As of now, given that there are some fairly significant regulatory changes on the anvil, we are holding what we said. Internally, of course, we're targeting a slightly higher number, but we had said 15%, which is on the upper end on a full year basis. Yes, it's looking pretty good in terms of first 4 months, and like you said, upwards of 30%. But let's also be honest that there was a base effect, and so numbers for us and for everyone else is slightly looking more elevated. On a 2-year CAGR basis, it's in the mid-20s. And that's what, so it's not very different to where we are saying 15% internally targeting a little bit higher numbers. But I think I'll have a better view once the surrender charges and that new regulations are implemented. Lots of things will undergo a change. And I think right now we just want to go with focusing on business. So
15% is the conservative view that you would want to share at this point of time, but there is an upward or a positive bias internally that you have.
I would think so. All things being equal, on the regulatory front, 1st of October it comes into being, because then you can build a business model around it, and with very little in terms of further changes, then with the stability of business models, yes, there should be a bit of an upward bias on it.
Okay. A little on the value of new business as well. Do you expect that side, which will of course be a function of the margins also, but do you expect it to grow in tandem with the APE growth? And you've spelled out a 4-year target also towards that.
That's right.
But would it grow every year for the next 4 years in tandem with APE growth, or could it exceed that?
It's become a way of life that at least you will double your VNB every 4 years, regardless of the ups and downs. And there will be very young sector, and there will be something or the other that we have to look at from a business model change perspective. And so nothing has changed. That's what we have been delivering in cohorts of 4 years, and we will continue to deliver. Again, top line doubling and VNB doubling. Whether it's 4 or 4.25 years, so we are saying about 18%. Between 17 to 18% is 17.5, 18.5. That kind of a range is what we have been delivering, and that's what we are internally targeting.
Okay. A little bit on the margins, because that has become the center point of discussion for this financial year. Your first quarter ULIP share went up to about 38% of individual APE as compared to 25% year on year, and we've seen that gradual increase since the last few quarters. Now, you've said in the conference call after the first quarter that you expect ULIP share to moderate. Now, I assume that large part of that, significant part of that moderation, you are indicating that it will come because the other product categories will grow, will take a higher share, and not ULIP share will come down largely. In that situation, I want to understand by the end of this year, with other product categories growing and taking a higher share, where do you expect the ULIP share to be over where you ended FY24? And in terms of margins, if that moves as per your understanding, the ULIP share, onto your margins, where do you see them? Where do you see yourself ending FY25 at?
I don't even have to wait till end of the year.
Okay.
We are already there. Okay, so happy to share that whatever we have said, that ULIP was elevated thanks to the markets. It's already coming close to about a third of our business. Some of our channels are sub 30%.
Okay.
Right, so it's already been achieved. Our non-par, I'm happy to share, is growing at and in the first quarter itself grown by about 41%. Happy to share that our latest avatar of Click to Achieve has been 100 crores in 16 days. Right? So we will continue to be a product factory, an innovator, and we will continue to launch products that we think are relevant for the customers. And ye naya kya hai question for us to keep going back, for our partners to keep going back, that is something that will continue. So it is important for us, and we've already, the limited point is, we've already started demonstrating that ULIPs are quite at a range that we are reasonably comfortable.
ULIPs, of course, coming in the comfortable range. By the end of the year, by the next couple of quarters, which product segment do we see actually accelerating as a share of the individual AP where we stand today?
Definitely non-par. And like I said, we've just launched this blockbuster product. So that's showing very good traction. Also, in terms of the impact in the new regime, it's something that we have been talking to our partners and seeing how it can be mitigated. So if that settles down, then that segment should do reasonably well. Term is continuing to grow faster than company level growth, and so we had about 28% growth in term in the first quarter. On sum assured basis, very good numbers, about 46% on retail sum assured that we've shown growth on. So term should nicely continue to increase, and annuity as well. Even with annuity, to some extent, I have called out irrational pricing on annuity, wherein if I'm giving an annuity today than any instrument that I could possibly lock into, else I'm giving a rate wherein it means zero spread for the company, then not much interest that I have in a product like that. Right? So we do believe that a little bit more rational behavior, like we are beginning to see a little bit more rational behavior on term pricing, that rational behavior will start coming into annuity pricing also. Okay. So term, annuity, non-par, I do expect to see an uptick.
You've told me protection will grow, you've told me non-par will grow, you've told me ULIPs have come down. What does that leave you in terms of an estimation on the margins for the year?
This year, like I have articulated on our call, we're not tethered to a margin. Last year we ended 26.3%. Correct. I don't want to be tethered, and I'll explain why. At the same time, the caveat is we are not looking to drop margins by 400 to 500, 600 basis points, which has not been unusual in our sector. Correct. So I'm not talking about that margins could be free fall as long as I give the top line, like I mentioned to you. That's not what I'm saying. Now I'm saying that, like in our earlier part of today's interview, that I will grow top line, I'll double over 4 years. I will do the same thing in terms of VNB. Correct. Margins will be range bound, give or take 26.3, 100 basis points, 150 basis points here or there. It could be, because my focus and the ranking of priorities has been top line growth, so that we continue to be slightly higher than overall industry. Right. Second is VNB growth. Margins will be an outcome of that. Only reason I'm saying that is because of unit linked. The fact that equity markets are still very, very elevated, I don't want to say no to good business, although it comes in through the door as unit linked. Now,
you mentioned about protection, and I want to come to that. The first quarter protection growth of individual AP was flat at about 6%.
No, the growth was 28%.
No, the share.
The share, yes.
The share was 6%.
Yes.
14% of total AP versus 18%.
Yes, correct.
32% of NBP versus 37%.
That's right.
So, somewhere it remained flat as it was.
Yes.
Somewhere it came down.
Yeah.
what came in that strong story for protection that we were talking about, and do you expect this to continue for some time, or do you expect this to bounce back if it was just a one-off from the next quarter itself?
Yeah, so let me deconstruct it. Like you said, retail protection, very strong growth. Credit life was flattish, and hence overall number as a percentage came down.
Okay.
Credit life, there are 2 or 3 parts into it. So the MFI book is about 1/3, and we know that the pain a lot of the MFIs went through in Q1 and are continuing to go through.
Correct.
Similarly, some of the NBFCs are also going through fair bit of pain. And we also believe in right pricing. So what is the pricing commensurate with the claims that we are seeing? That triangulation means that little bit of slowdown that we saw. On HDFC book though, we are fairly optimistic about getting a pickup in the second half of the year. However, on the rest of the MFI and so on, we'll have to wait and see in terms of how some of the geographies are going through, especially some of the northern states, how are they going through their experience on NPAs and so on, as well as for our industry in terms of the claims, in terms of right pricing. So a little bit of state of flux is there. I would expect, given that we are the largest player in the credit life space, and given that we want to be fairly calibrated on pricing, it will be, the growth will be lesser than retail protection, as a result of which you will see that the kind of outcomes, very similar outcomes you will see as you saw in Q1.
Okay.
But that is okay because the uptick in VNB continues to be strong. The number of lives covered continues to grow, and the sum assured is growing almost by 46%.
Correct.
So we will grow the book faster and healthier than an overall savings book, and that's a good place to be.